Risk versus return is perhaps the most difficult conundrum investors face. In order to gain meaningful real returns in financial markets, one must be exposed to some level of risk. But what exactly does risk mean in a financial context? Well, risk can include capital risk, as in security of your invested capital. It could mean inflationary risk and the impact inflation may have on your money or investments. It could mean currency risk, credit risk, interest rate risk, liquidity risk, stock-specific risk, or geopolitical risk. Risk covers a lot of areas, making it one of the key challenges facing investors. This is why it's so important to manage risk when investing and sticking to your strategy, whatever the chosen time frame, short, medium, or long term. Now, the chart here shows the rolling periods of the S&P 500 from 1928 to 2023. If one invested in the S&P for just 1 year, then on average, there's a 73% probability you would have made money within the aforementioned time frame. However, if you had simply stayed invested for 10 years, that figure jumps to 94%. And if you really had a long-term time horizon, staying invested for 20 years would have meant you have 100% opportunity of making money in the S&P 500. What this chart tells us is that by looking through risk and focusing on a clear strategy is one of the safest ways to guarantee a return in a risk versus return scenario. For more insights such as these, please visit our website, www.seaspareprivate.ie.